wanted to thank the panel for being here and thank everybody for getting up early on the Thursday morning after we know Wednesday nights are usually a good night for some good dinners. So I thought what we'd do is start off by maybe giving a little more color than just the name introductions and what your firms are and what your strategies are. So you want to kick it off, David?
Sure. My name is David Lyon. I'm a managing director at Neuberger Berman, and I co-head our private credit business, which is about $4.5 billion. And about $3 billion of that strategy is dedicated to what we call direct lending or origination. We're focused exclusively on private equity firms. So we originate first lien debt, unitranche debt, mezzanine, second lien debt. And we have another pocket of capital that's $1 billion and change that's dedicated to opportunistic investing. And that's everything from stressed, distress, traded loans, bonds. We originate holdco instruments. We do rescue financing. So it's a very flexible base of capital. And really our core differentiation on the origination side is our platform also has connectivity with private equity. Neuberger Berman is a large investor in private equity firms on behalf of institutions. I think we're invested in over 500 private equity funds. We sit on 150 LPACs. We have a business called Dial, which owns minority stakes in some of the leading private equity firms. And all of that's really just to say that we're pretty tied into that little ecosystem. And the most important thing in origination is deal flow. And I'm sure you've heard that before. So that really kind of is the hallmark of our strategy.
Adam?
I'm Adam Vigna. I'm the managing partner and chief investment officer of Sagard Holdings. Sagard Holdings is the alternative asset manager for Power Corporation of Canada. You may not be familiar with the name Power Corporation, but there are $1.5 trillion assets under administration, 500 billion balance sheets across the globe. They own such interests as Putnam here in the US. They're the largest shareholder in China Asset Management, 30% shareholder, largest shareholder in Personal Capital. Sagard Holdings, which I'm responsible for as the chief investment officer, we really have 4 distinct investment businesses today. One is our long-term private equity business. The second is our drug or pharmaceutical royalty business. The third is we have one of the largest dedicated fintech VC equity funds across the globe. And the fourth, which we're here to talk about today, is our direct credit business, which today we're focusing our direct credit portfolio on the non-sponsor North American middle market, which we'll talk about a little later on.
Hi, Farrell Akane. I'm the Director of Growth and Operations for OakNorth Analytical Intelligence, which is a fintech platform built and designed to use credit analytics and credit monitoring. And the techniques we use to do that are based on machine learning, big data, and AI. And it's a platform that can be used both by commercial banks who are directly lending to small and medium-sized businesses, and can be used by investors who are investing in the small and medium-sized space. So it's a fairly robust platform. We've actually used it in our own bank, which is based in the UK, OakNorth Bank. It's now about 4 years old, $4 billion portfolio size, again, built on the backbone of this AI-based platform. And in the US, we are using the platform with a couple of very large banks and a couple of investment funds, again, using big data, AI, and machine learning concepts to make risk management better and make investment better on both sides of the spectrum.
I'm Howard Levkowitz. A little over 2 decades ago, we started a firm called Tenenbaum Capital Partners, with the focus being providing credit-oriented solutions to borrowers who didn't have access to capital. That was long before this industry had a name or people were worrying about whether there was too much capital in it. We grew our firm to about $9 billion and sold it to BlackRock this past summer. We're now part of a $6 trillion institution, and we focus on providing solutions to corporate borrowers up and down the capital structure, but with a real focus on senior lending.
Great. Well, thank you, everyone. All right, so to kick this off a bit, I'll give you an overview of what we're going to discuss today. So I'm going to take you through a couple of questions around why direct lending, private credit has become such a hot asset class, and we'll get the panelists' views on that. We'll talk about differentiation. So how is everybody differentiating in this relatively new but very large space? We're going to also touch on what are the things that keep people up at night. I know it's a key question of investors. And then we're going to talk about some disruptors. As we see, we have a pretty unique and diverse set of players from the industry here. So we'll talk about how disruption could be playing or might come in the horizon here. And then I'll leave everybody with a couple of one-off notes from each of the panelists that I think investors might want to hear. Again, I'm Doug Monticciolo. I'm the founder of Brevet Capital. We are an alternative credit fund based in New York. We are focused on government counterparties, and we'll give a little blurb as to why we do that. We're in similar space to everyone here. And we were started in 1998, which I think leads into our first set of questions here, because in 98, we went out fundraising, and we maybe saw 10, 12 people out there fundraising. There are actually times when we'd have a lunch with investors and our peers who are out fundraising because it was such a small market. We actually all knew each other pretty well. Tannenbaum was there and a bunch of others in those time periods. And now we look at it, and Preqin shows that there are 407 funds in the market right now looking to raise a private credit fund for about $180 billion. From 2007, that number is up from about 250 funds for about half that number of AUM. So quite a big growth in just a relatively short time period. And half of those funds are looking for what everybody calls direct lending. So given that change, I think it would be really good to hear from the panelists as to what has changed, why is there such tremendous interest from investors on this, what's the attractive nature of the fund? So hey, Adam, you want to kick that off?
Sure. Like, I think when it comes to the growth of private credit over the last decade plus, I mean, we've really come into this, what I would call almost a perfect storm. At the eye of the storm, or what's really been the catalyst for this growth, was really regulation. I mean, when you had regulation come in post-crisis, the traditional capital providers, the banks in the US, were no longer able to be as competitive as they historically would. So as a result, you've had the shadow banking system, you've had the emergence of all these new players that have come into the space to basically fill up and take the market share from the existing banks. And you've seen that with whether the growth of like GSO, who had 50 billion of credit assets in 2012, is now over 200 billion of credit assets. Whether it's folks like Owl Rock, who were nothing more than a piece of paper in 2016 and today have over 20 billion of buying power. So regulation has caused the emergence of these alternative asset managers to come into this place today. That's at the eye of the storm. Flanking those two sides is really, a supply and demand element. On the demand side, name your private equity fund. If they were on Fund 1 or Fund 2 10 years ago, if they were $1 billion, if they've been any good, they're on Fund 4 or 5 today and they're going to be 20 billion. So tremendous amount of dry capital on the sidelines from a demand perspective. And then on the supply perspective, this is where the real attractiveness has come from. It's just basically on the LP appetite. When we meet with a lot of LPs, and prior to joining Sagard, which I came on in 2016, I spent 8 years at the Canadian Pension Plan Investment Board. And for those of you who don't know the Canadian Pension Plan Investment Board, it's a $350 billion pension plan. I ran their global credit business, but they at the time were also the largest allocator to private equity funds across the globe. And when pension plans take a step back and they look at their alternatives today, I believe, this is me alone, that top decile private equity returns today should be gross 18%. If you were a $500 million fund 10 years ago, and if you were able to generate 25% return, if you're now a $5 billion fund today based on 10 years into a bull market where equity valuations are, it's very challenging to say you're going to be able to generate those similar types of returns. So if top quartile gross returns for private equity today are 18%, based on their gross to net, their net is going to be about 12%, I believe, on private equity funds. So then when the investors take a look back and say, geez, I can get net 10, 11, 12% returns, which we're offering our investors on credit, that risk-adjusted return makes a lot of sense, and I think that's why we've seen a lot of LPs starting to pile into the space.
Yeah, I think just coming at it from another angle, the private equity comparison is one thing, but we're in a yield-starved world. We have been since 2008. And whether you're an individual trying to grow your nest egg or you're trying to live off of your retirement savings and pay the rent or come to Las Vegas, maybe go to a conference. Whatever your needs are, you need yield. And you can't get it buying QSIP securities. You can't get it buying bonds. You can't get it going into traded loan funds. The returns are simply too low. And so private credit provides a stable, historically proven way of getting these returns and achieving the kinds of returns on investment that both individuals needs and also pension funds, insurance companies, and other institutional investors. And I think that's a big reason you're seeing the interest on the demand side is we provide a solution for a real need in today's investment environment.
I mean, I would definitely echo the sentiments about, institutions are yield starved. You obviously, you can't really get anything exciting in the high yield market. It's very difficult to replicate the index. You're not about to buy bonds that are about to default. You have liquidity constraints. And so layering kind of fees on top of that, your net returns are, in the 4s and 5s. And so institutions certainly need some kind of, higher yielding instruments. So that's obviously fueled the huge demand for private credit. I would also say that nomenclature is important because everything today is private credit. So anyone who's doing anything puts private credit on a fund and goes and raises it, even though they're buying syndicated loans. So again, there's true origination where you're acting as that financial institution, you're signing up commitment papers, you're effectively the agent, and that's kind of more the direct lending business we're talking about. And there's all sorts of people in the middle that are buying loans off bank desks and saying, I'm in private credit. So I think that's one thing in terms of how the numbers kind of get mixed in. I think the other thing the asset class provides is no report card. There is no price discovery in private credit. A lot of institutions like that. There's no volatility in the space. And when people look at kind of correlations, they say, gee, these are great risk-adjusted returns because there's no price discovery. And again, I think depending upon the institution, they're certainly willing to trade liquidity, which they don't really have in the credit markets when they need it anyway, to embrace this higher yield.
The other piece, though, to think about is what did the banks go through during the crisis and post-crisis? So they had excess capital, which they've used up. They've now gone and done a whole bunch of cost measures, which are done as well, yet they're still sitting on 10 to 12% ROE generally. And so how do you unlock that lending space without taking away any of the advantages that you just went through with the cost cuttings, et cetera? So banks are starting to come to the realization that they are sort of sitting in a century behind everybody else in some ways, at least when it comes to technology, and that there are solutions out there that they can use and utilize to not only just increase the origination part of their business, but also managing the risk part of their business. Because right now, that's all that they can do. They've done everything else. They've pulled all the levers they can pull. Now it's just a question of how do you manage risk. So in order to do that, they need to understand, and we hope they're understanding, how to use data, AI, and all sorts of new cutting-edge technology to actually look at their portfolio in a different way. Today, they look at their portfolio maybe once a year, something called an annual review, which is basically a bunch of people moving a bunch of paper around. Yet they are not controlling their losses, credit losses. So the mindset is shifting because they see that there's actually a lot of opportunity, at least in the middle market space, and they're just not getting fully engaged with that space because either the borrowers are not giving them enough data, they don't have the ability to analyze things properly. They don't have the ability to be more predictive in terms of their risk management. So all those things actually play into that as well. And even though there is sort of a hole created by direct lenders, commercial banks, et cetera, that the private credit market has now started to fill, banks themselves are starting to come to the realization that they actually do need to catch up.
All right, so I'm going to throw out some mind-boggling statistics, I think, about what the market looks like for the other side of this picture, which is we just saw sort of an investor demand and appetite and reason why that's true. But the other side of the picture is are there the assets, and what does that mean? So an interesting statistic I heard just recently was between 1996 and 2018, the Wilshire 5000 went from approximately 7,300 companies down to as low as 3,600 companies. That means that public companies are either going private or being taken private by private equity firms. So that's obviously driving a lot of financing, a lot of private debt. On top of it, we just saw this week, the Federal Reserve came out with a financial stability report. You look in that report and you'll find that leveraged loans grew by 20% last year, the largest of any other asset class that they're tracking, by almost a factor of 2 to 3. So that's a very big increase. It's the largest growing asset sector according to the Fed. That is focused on the Fed's data in terms of assets, but it is a tremendous growth amount. And we can see that by a Credit Suisse report recently that showed between 2007 and 2018, funds went from private credit funds, went from about 500 billion to 1.5 trillion. And so we're hearing all kinds of trends looking forward, such as there's $1.3 billion or $1.3 trillion approximately of dry powder in the private equity space. Does that mean that it's going to drive another $1 trillion or $2 trillion of financing? We also just heard last week of a $2 trillion infrastructure proposal, all of which is going to need additional financing. Right? The biggest question on all those proposals is, where does the money come from? Right? We hear this over and over. So, I put out you think about these numbers, they seem fairly large. It seems like there's tremendous asset opportunity. How do you think this is going to be met? Do we think those assets will drive? And maybe, Howard, do you want to kick us off on how do you see approaching that?
Sure, Doug. You just described a lot of potential supply.
Yep.
So fewer public companies, more private equity, more infrastructure. But I want to emphasize potential. The mere fact that we've had these changes doesn't mean that these are loans that we or anybody else up here are going to do. Every one of these entities takes different paths. Some of them aren't borrowing. Some of them are accessing the syndicated markets. What it does mean, I think, is there's a lot of dynamism in the economy. The data set we use has about 200,000 middle market companies. Mm-hmm. And so that's far more dramatic than the 3,500 or so that have come out of the public markets. That is a huge market. And some of these entities can go through traditional methods to borrow, either banks or capital markets, but many of them can't. And they can't because of the trends we've talked about. They can't because they don't want to. They need certainty of closing. They need somebody who can move quickly. They need somebody who's flexible. Maybe they're buying a corporate carve-out. Maybe they want to have an accordion so they can keep growing their business. There are lots of distinctions that cause people to come to us and want to have the flexibility that we've built up, with our industry expertise, having done this over 2 decades. And I think everybody in this business sort of has their own way of positioning. But the way we think about it is you have to be able to provide a uniquely tailored solution to people that gives them something they can't get out of the capital markets or by having some long auction. Otherwise, you're not providing value added. And so that's the way we go about it. But I think overall what you're seeing is a lot of dynamism in the economy, a lot of changes. The economy is growing, some sectors more than others. And you see businesses, even those that aren't growing, in some cases needing more flexible financing. And that's what's opening up the opportunity for the direct lending, combined with the fact that people need to put the money to work and get the yields. So being able to invest in funds that construct and actually manufacture these loans and do the diligence and structure the deals is a real value added, both to the investors and to the borrowers.
Yeah, anything else to add on that? Adam, David, it's up to you.
No, I think everything, I echo everything that Howard said. I mean, and we're positioned similarly, right? I mean, we focus on those 200,000 middle market companies in the U.S. or a much smaller subset of them in Canada. But, and that's effectively what we're trying to provide is capital, but value-added capital. I mean, banks are great. They provide very cost-efficient capital, but a lot of banks still today have their sheet of paper and everything has to check that particular box, whereas someone like anyone on this panel can go in, sit with the owner, sit with the entrepreneur, sit with that public company CEO, actually understand what his or her needs are or issues, and actually provide them with a tailored solution. And that's the delta what this space is able to provide, what this panel is able to provide, is we actually can provide solution-based capital, because capital in its purest form is a commodity. So how do you shift it to make it not a commodity? And that's where you become a solutions-based capital. And I think what's changed specifically about the space now, because of regulation, is that all of these capital providers on the stage today, or all the private direct lenders, whether it's GSO, Highbridge, et cetera, they all now have those, they own those relationships with the ultimate borrowers. 10 years ago, if you were a borrower, to get a market deal, you had to go through an intermediary like an investment bank. Today, you have that direct relationship with the GSOs, with the Highbridge, where you know you can get a marketed deal from them, and you no longer need to go through an intermediary to get a solution.
Yeah, and just on that point, these borrowers, they certainly want bespoke solutions and have clear needs, but they also want a decision fast, right? If you're a borrower that's opening a new hotel and you have to wait 3 months for a decision, that doesn't help you at all, no matter how great you might be, right? So I think the question that at least we are trying to solve within our platform is how can you get to the decision faster without losing anything on the credit quality, in fact, enhancing the credit quality, right? Using the data that's available, external data, borrower data, and some methods of machine learning, et cetera, to get you to that decision faster without degrading credit quality, in fact, improving credit quality in the long run, right? So that's the piece that we are trying to solve for. And it's certainly something that is needed in the market, because you can be great at analyzing credit, but if you take 5 months to do it, it's useless, really, for the borrower.
All right, so one of the things I'll point out there that you heard a couple of times mentioned was the word solution, right? So it's not just money. I think one of the things about this panel is everybody here actually is providing a real value-added service to the borrowers. It isn't just money availability, right? You're hearing customized solutions or providing either faster response or a better service or a more managed financing for the borrowers, which I think is the true value add. I think it's how you do create additional returns. And that's what we've seen in our business as well. And that leads to a question. Maybe you give each one of you a brief synopsis of just what would you view as your differentiating factors? And then we hear private credit is this big space and seems to be completely homogeneous. But you'll hear here that it's actually not a homogeneous space. There are parts of it that are. But I think if you could each maybe give a little bit of what is the differentiator? I mean, there's all this money, there's all these opportunities. How are you differentiating in this market?
Sure. I would say private equity, given kind of the growth in middle market PE and all these funds that have kind of come from nowhere in the last 10 years to being a huge part of the market, that's the business that's most at risk for being commoditized. For any one sponsor saying, hey, I'm buying a company that has 30 million of EBITDA, and I want to do $120 million financing, it's L500, let me call the 5 guys I always call. And certainly you've seen spreads in that business collapse. I would guess over the last 4 or 5 years by 100 to 150 basis points. And also people use the word unitranche, which just basically means a lot more first lien debt, usually over 5 times. And certainly spreads in that space have come down. And that's because private equity is a very easy constituency to cover. And that product is a very simple product, and you're really not providing a lot of solutions. But having said that, there are things, and people referred to it earlier, about relationships, about speed, about way they handle transactions. So you don't waste people's time. You don't spend 2 weeks giving someone a no. You deal with people professionally. You ask intelligent questions. You do your homework. You just don't submit lists for reams and reams of information. And you can move quickly. If someone calls you and says, I need a commitment in 3 days, traditionally banks couldn't do that, but we can. So while I was saying parts of the business have become commoditized, you can clearly differentiate yourself by those deep relationships, especially on the kind of the plain vanilla first lien financing. And then as you get more complicated, a sponsor wants to do an acquisition, existing leverage is already high, the acquisition might be transformative, you can provide some kind of hybrid capital to help them do that. And again, that's where you're kind of acting with deeper value add and providing solutions to these folks. So it's a whole spectrum, but even despite kind of all the players in the space, those relationships and the way you conduct yourself, it really matters.
Yeah, from our perspective, we differentiate ourselves. Really, one is on our sourcing engine. So we're not focused on sponsored at all. We're focused on dealing with public companies or private family-owned companies in North America, sub 50 million EBITDA. And we have a unique sourcing angle, whether it's through the existing team, whether us being part of this power ecosystem, the different entities they own in the US. And as a result of that, just for some numbers, like since January of this year, we've looked at 250 proprietary deals. And so we differentiate ourselves to our investors as sourcing, and as a result of that, we're able to get these deals, and we can actually get net north of 10% unlevered returns to our investors. To the actual borrower, where we're differentiating ourselves is we can provide them capital, solution-based capital, et cetera, but I can also go to that CEO or that owner and say, you've owned this business for 30 years. We're backed by a family. I can not only provide you capital today and provide you with the capital you need to hit your goals, but I can also take you entrepreneur and I can drop you into our family's ecosystem. So our family is the largest shareholder in Adidas. Our family is the largest shareholder in Imerys. So if you're a mid-market company in the US in the consumer space, I can take you and I can help you and I can put you into that ecosystem in Europe or in Asia. And that's huge value add to the ultimate borrower.
For us, it's just generally trying to understand and use analysis and data to cater to a market that has actually been fairly overlooked by technology. So if you look at the lower end of the market, sort of sub 500,000 loans, it's very well served by very good companies and companies driven by technology. And then you go up to the, above $50 million, et cetera, and you go into the corporate loan side of large banks, very well served, don't really need technology. It's okay because the fees are enough to justify that. So the middle piece of the middle market space just gets very ignored with technology, and that's what we are providing. We are providing institutional type analysis in a platform so that you can get to a credit decision faster, and then once the loan is made, you can actually manage your risk better by using data to manage your portfolio, right? So it's all great to say all these buzzwords, machine learning, AI, et cetera, but you actually have to build it and have it be proven that it actually works. And we've done that. We've proven it that it works in our bank in the UK. We are proving it with our client banks today and our client investment firms today. So it's just a question of how do you take all the data that exists in the US market and use it to make credit decisions for the middle market space, which gets fairly overlooked because either these businesses are not large enough to have a lot of information, or these businesses are sort of divided and sort of dispersed, so you can't really get a lot of data. So we're trying to get away from the fact that you as a lender or you as an investor are solely relying on the data you get from the borrower, which may be very haphazard and maybe very sparse. So we're trying to solve that problem, basically, and we've solved it, and solved that problem in a way that actually gives you higher returns. So it's sort of all connected in our platform and in our universe, but the idea is that that's where the world is going, right? Steve and Mark yesterday alluded to this, that AI and data and machine learning, that's just the reality now. This is not, buzzwords, this is not futuristic, this is now. So what we're trying to do is use that to actually cater to a space that has been fairly overlooked, at least from the technology point of view. So that's our differentiator, I would say.
So we differentiate ourselves in a couple of ways, starting with the long history and relationships that we have. Yesterday on our public earnings call for BlackRock TCP Capital Corp, we stated that in the first quarter, over 60% of our corporate loans were made to existing borrowers. That's pretty powerful. That's something you only get when you've been in business for a long time and have strong relationships. Also, industry knowledge. We're focused by industry. We have a lot of expertise there. We use the same teams that do our special situations investing. So they're sitting on boards of companies. They've been involved with companies, really know the industries. And what we've found is that enables us to develop real relationships and add value. As an example, yesterday I was in touch with a longtime borrower of ours, family-owned business. We've loaned money to the family a couple of times. The largest loan they ever took out, they paid us 20% more than another offer. We saw the other offer. It was a good offer. It was one of their other existing lenders. Why would they do that? Why would anybody do that with their money? We'd been there for them. We'd been understanding when there were some bumps in the businesses. We'd worked with them. We'd brought in people to help them think through problems. People involved with our company understood the business and helped really think through some of the strategic issues, and they were willing to pay up to have us involved. These are the kinds of situations where we differentiate ourselves and add value. And ultimately, it's being a good long-term counterparty for people so they'll come back and continue to want to do business with you.
I think it's good. And again, I bring up that point of adding value, right? This is adding value for borrowers, differentiation from the various managers here. So given that we're trying to solve problems for borrowers and trying to hopefully be paid for that as well, which I think we've noticed that in our business that is respected, particularly by private companies. But given all that we're hearing in the market, 90% of loans are all covenant light, there's 15 bids for every transaction, the space is much bigger than I think everybody thinks it is. Those comments about cov light and everything probably are in niches of the space. So when investors are coming in to meet with managers, I think there's two things that I'd like each of you to maybe throw out there is, one is, what is the thing that's keeping you up at night as you as a manager? And two, if you were to give some advice to an investor and you were in their shoes, what would you be telling them to ask a manager?
Sure. I really wouldn't be focused on cov light. That really applies to the syndicated loan market. It's a $1 trillion market, and over 90% of it's cov light. And I always tell my investors, it's great you got a covenant. First of all, it was based on a made-up number. So by the time that they actually hit that covenant, it's way too late. And you're at the table now. Is that going to get your money back? I think covenants are great to have, but they won't protect a bad investment. I look at the one thing that really concerns me is that in this last 10-year period where we've had incredibly low rates, and we always look at kind of recovery data from the syndicated loan markets and look at default rates and say, gee, let's triangulate a really bad outcome. So in 2008, 2009, defaults peaked at 12% in the loan market. And you look at Moody's data over 25 years, recoveries are 70 cents for first lien loans. I think the question that I ask myself is, will recoveries be the same? When folks are paying 12, 13, 14 times for these assets, maybe some of these assets shouldn't have been levered in the first place. Maybe some of these business models will not basically be resilient in a different rate environment. That kind of gets me to thinking about what is that recovery data, right? What is the real value of these companies? And I think it's very easy to be formulaic about it, but that's really what concerns me. And I think in terms of question that I would ask a manager, I would really focus on kind of honesty. I'd focus on integrity, and I'd ask them about mistakes they made. I'd ask them about current mistakes in the portfolio, and I'd ask them why they made them and what they learned from them. And if you get someone who kind of brushes over it and says, oh, I'm really smart and everything's perfect and we don't ever make mistakes, I think that's not the answer you're looking for. I think you want someone to say, yeah, this was stupid. I own it. This is how we're going to try to fix it. If I can't fix it, this is your loss. But here's our performance over here. So I think those are the kind of two answers to that.
Yeah, look, I think as a GP, some of the concerns or some of the things that we worry about is I would echo David's first comment on just general recoveries. Defaults are one thing, but loss given defaults are what really matters. And so when you think about valuations today, if it's companies being bought or worth 10 times, if you're putting 6.5 times leverage on it, is that company really worth 10 times or is it really worth 8 times through mid-cycle? So I think looking at absolute leverage levels is one thing that keeps you up at night. And then within that, all of our deals have 3 to 5 maintenance covenants. Then it's actually done off actual EBITDA. And so if you're investing, is it actual EBITDA? Is it adjusted EBITDA? Just understanding what that document looks like, I think is something that a GP needs to be concerned about. I mean, we looked at a transaction earlier this year where, merger of two companies. Company one was $7 million of actual EBITDA on a trailing basis. Company two was $10 million of actual EBITDA on a trailing basis, so 17 combined. They were financing an off adjusted of $42 million. So those are some of the things that we think about and we're concerned about from a GP side. As an LP, there's a couple things. One, I would be asking managers what is your workout experience? What has been your experience through a cycle? I was speaking at a conference earlier this year where they did a study or they did a survey of all the managers that were in the room, and 80% of the managers that were in the room had only been in business for 8 years. A monkey could have made money in credit over the last 8 years. If you did not make money in credit over the last 8 years, you should not have a job. So first thing you need to be asking your managers is, what is your workout experience when things go wrong? I think the second thing a manager needs to be, an LP needs to be thinking about is, when you take a step back and look at how this space has evolved, 15 years ago, we've had the emergence of a lot of these players, these private equity guys gone public. You know, KKR went public in 2010, Blackstone went public in 2007. And what did that do? Effectively, that changed them from worrying about carry to all of a sudden becoming public. And as a public company, they care about AUM and ultimately fees. Because fees is what the public markets value them at, and that's what they're incentivized at, and that's what where they're aligned. And so if you're a manager today, this private credit class is fees on invested capital, not on committed capital. So I'm not saying Carlyle or any of these guys operate in that fashion, but you should be asking them, are you just investing for the sake of investing? Because if you invest, you get your fee stream up, you get your AUM up, and if you're an owner of that business, that's actually how you're incentivized by the share price going up.
Yeah, on the technology front, it's more about how do you, even if you have a loan that's covenant light or has 5 covenants, 10 covenants, whatever it is, how do you get to a point where you can actually predict if the borrower is going to break the covenant before it actually happens, right? That's what we are trying to solve for in our portfolio management part of the platform. Can I predict, even if it's a month out, 2 months out, whatever it is, using the cash flows that the borrower has given me, can I predict in some way that there's a covenant breach coming? And if I know that that's going to happen, can I do something today to mitigate that, right? That's the whole power. I mean, that if you don't know anything about machine learning and AI, that's the one thing you should take away, is that is the power of machine learning and AI, that it can actually be more predictive rather than backwards looking. Now, the question is how far predictive? Who knows, right? We are still developing the technology, but the point is, as long as it is predictive, there is some measure of risk management that you can actually apply and use practical solutions today to mitigate that risk to a certain degree. So the ideal part of where we are going with the platform is saying that you shouldn't have to get to a point where you're saying, okay, how does this borrower perform in the down cycle? If you're using the platform and you're using it right, you should actually be able to see the downturn and figure out what to do about that today. Whether you can do something about it, not do something about it, or manage your own IRRs that way. That's where we are trying to play. That's sort of at the edge of technology, really. So that's what sort of is our value add, and also something that keeps us up at night, right? So how do you build those algorithms and make sure that they actually function in every scenario for every sector? Because remember, for middle market borrowers, every sector has very different nuances and very different things that you have to look at. So it's just getting it all plugged in and the plumbing put together to actually make it predictive and have it be tested to be predictive.
Eric?
A lot has been covered on due diligence. I'll add this. I think if you're looking at a manager, it's about people, people, people. And not just what are their resumes, it's what have they done together. We have a lot of people who've gotten into this business who maybe come from a bank, another firm. They look good on paper. Have they worked together? What is their investment process? Have they established something that has longevity and is replicable? As we think about the way we built our business, we set up an investment committee process going back 2 decades ago that was really designed to involve all of our investment professionals and get their input and learn from it over time. And so when you're looking at any manager, I would just encourage you to really delve down and say, not just what have you done in your prior life, what have you done in this capacity that I may be hiring you to do today? What has the outcome been? And think about that as you're going into it.
Thank you. Right, we got 1 minute here. Anybody want to jump in with one question? Is what is the one thing that no one is talking about that you think investors should know about? And should they keep those super short, kind of like a shotgun kind of round here? It's one quick thing. Anything?
I think you're going to see a ton more consolidation in the space. I think you've seen it with Brookfield, Oaktree. I think more guys are going to do it to get more scale in the space going forward.
As we've seen.
Idiosyncratic risk. Look at the number of S&P 500 companies, the most followed companies in the world, that miss their numbers in a benign environment, and I think you're going to see more of that. Good businesses, businesses that have been around for a long time, whose businesses are getting challenged or disintermediated, and I think it's incumbent on us to be really looking forward as we're making our investments, because what used to be true no longer is for many businesses.
Data.
Data. Disruption.
How do you take very sparse and diverse and fairly deficient borrower data and make a decision based on using data techniques, using data outside of what you already know, unstructured data, structured data, algorithm learning, to actually end up making a decision that is better than what you could have made before? That's the next wave.
I would just say people talk about a bubble in private credit. And if that's the case, I would look very, very close at your other asset classes.
All right, well, thank you very much, everybody. Thank you for coming this morning, and thank you, panelists, for participating.
Thank you.